A bear market can feel like a financial nightmare. Falling stock prices, shrinking portfolios, and uncertainty everywhere. Many investors panic during bear markets, selling their holdings at a loss and missing opportunities to profit. But the truth is, a bear market isn't just a threat. It's also a chance to build wealth strategically. In this video, you'll learn what a bear market is, why it happens, and how you can respond wisely to protect your portfolio and even find opportunities. By understanding bear markets, you can navigate volatility with confidence instead of fear. Bear markets are a natural part of the economic cycle, and they can't be avoided. The key is preparation, strategy, and discipline. Investors who understand the rules of bear markets often outperform those who react emotionally. By the end of this video, you'll know how to recognize market conditions, minimize losses, and even position yourself to take advantage of downturns. With proper planning and knowledge, you can even profit during market declines. Let's break down bear markets and explore strategic ways to play in 2025. 1. What is a bear market? A bear market occurs when stock prices fall 20% or more from recent highs, usually accompanied by widespread pessimism. It reflects investor fears about slowing economic growth, declining corporate profits, or other negative events. Bear markets can last months or even years, and they often follow periods of overvaluation or market exuberance. Understanding this definition helps investors distinguish between temporary drops and a true bear market. Bear markets are different from normal market correction, which are smaller and shorter term. They are characterized by sustained declines, lower trading volumes, and increased volatility. Investors often experience fear, uncertainty, and doubt during these periods. Recognizing a bear market early allows you to adjust your portfolio and protect your investments. Bear markets also reset valuations, creating opportunities for disciplined investors to find undervalued stocks. Being able to identify a bear market can prevent rash decisions and improve long-term performance. Top guide causes of a bear market. Bear markets are triggered by a combination of economic, political, and market factors. Slowing GDP growth, rising interest rates, or high inflation can spook investors. Corporate earnings declines or widespread financial instability often contribute to market downturns. Global crises such as pandemics or geopolitical conflicts can accelerate declines. Investor sentiment plays a huge role in bear markets. Fear spreads quickly, causing widespread selling. Market bubbles that burst, excessive leverage, or overvalued sectors can all ignite bear conditions. Even psychological factors like panic and herd behavior amplify declines. Understanding these causes helps investors avoid panic and focus on fundamentals. Bear markets are rarely caused by a single event. They're the result of multiple pressures converging. Recognizing the underlying causes can help investors prepare and make rational decisions. 3. How long do bear markets last? Bear markets vary in duration, typically lasting anywhere from several months to a few years. Historical averages show bear markets last about 14 months, but each one is unique. Recovery depends on economic conditions, corporate earnings, and government interventions. Understanding duration helps investors stay patient and avoid selling too early. It's important to remember that while bear markets feel prolonged, rebounds often follow quickly once conditions stabilize. Long-term investors who remain disciplined are usually rewarded when the market recovers. Some sectors recover faster than others, creating opportunities for strategic allocation. Timing the market perfectly is nearly impossible, but staying informed and prepared reduces anxiety and mistakes. Bear markets test emotional discipline, but they also teach resilience, patience, and strategic thinking. Investors who understand the typical timelines can plan better and reduce stress during downturns. 4. Common investor. Mistakes in a bear market. Panic selling is the most common mistake during a bear market, locking in losses unnecessarily. Chasing hot stocks or high-risk trades in fear of missing rebounds often backfires. Ignoring portfolio diversification can amplify losses if a single sector crashes. Many investors also overreact to daily headlines and short-term fluctuations, rather than focusing on long-term strategy. Emotional decision-making during a bear market can derail years of disciplined investing. Failing to review and adjust your portfolio is another common pitfall. Some investors avoid bear markets altogether, staying in cash and missing opportunities to buy undervalued assets. Overconfidence or assuming markets will immediately rebound can also lead to mistakes. Ignoring long-term goals or lack of planning compounds losses. Recognizing these errors allows you to stay calm, disciplined, and proactive while taking advantage of market conditions. 5. Defensive strategies to protect your portfolio. Diversification is key, like spreading investments across stocks, Bonds, ETFs, and other assets reduces risk. High-quality, dividend-paying stocks tend to perform better during downturns and provide income. Holding cash or short-term bonds allows flexibility to buy at lower prices. Using hedging strategies such as options can protect downside risk. Rebalancing your portfolio to reflect changing market conditions helps maintain risk control. Focus on companies with strong balance sheets, stable earnings, and low debt. Defensive sectors like consumer staples, utilities, and healthcare often outperform in bear markets. Staying disciplined and avoiding panic selling preserves capital and positions you for recovery. Pairing defensive strategies with regular portfolio reviews ensures you remain prepared for ongoing volatility and unexpected market events. Consider keeping a portion of your portfolio in non-correlated assets to further reduce risk. 6. Opportunities. During a bear markets create opportunities to buy quality assets at discounted prices. Historically, the best long-term returns often come from investing during downturns. Companies with strong fundamentals may temporarily drop in price but recover strongly. Dollar-cost averaging allows investors to gradually build positions without timing the market perfectly. Investors can also explore counter-cyclical investments like gold, bonds, or other assets that perform well in downturns. Sector rotation, moving into defensive or undervalued industries, can generate profits. Strategic investing during bear markets requires research, patience, and discipline. Instead of fearing declines, view bear markets as a chance to strengthen and diversify your portfolio. Savvy investors treat bear markets as opportunities, not threats. Planning strategically allows investors to enter positions at lower valuations and benefit during the recovery. 7. Preparing for the next bear market. The best preparation is proactive rather than reactive. Build an emergency fund, reduce high-risk positions, and ensure your portfolio is diversified. Define your risk tolerance and create a written strategy for how you'll respond if markets drop. Keeping cash reserves allows you to capitalize on opportunities when valuations fall. Invest in knowledge, understand market cycles, valuation metrics, and historical trends. Set realistic expectations for returns and avoid over-leveraging your positions. Regularly reviewing your investments ensures you stay aligned with your goals. Preparation builds confidence, reduces stress, and increases your chances of outperforming during market declines. Being prepared allows investors to act calmly and seize opportunities when others panic. Rehearsing your plan during normal markets ensures you're ready when volatility hits. This video helped you understand what a bear market is and how to play strategically. Start applying these lessons to your portfolio today. Focus on diversification, defensive strategies, patience, and disciplined investing. Share this video with someone who wants to survive market downturns. Hit the like button and subscribe for more actionable investing insights. Remember, bear markets are not the enemy. They're a chance to protect capital, buy undervalued assets, and grow wealth long-term. Prepare today, stay strategic, and turn market challenges into opportunities.